What is up, YouTube? This is Vic's Financial Strategy, and in today's lecture, we're going to be talking about the S&P 500, kind of where we sit at in this current moment. We're going to just have a conversation on future projections, what I believe we could see happen in the coming weeks, months, in the near term, and future projections. Did I say that? Well, I meant to say future projections and predictions, but we're also going to be looking at some data. This is the personal savings rate, and we have the personal savings rate when compared to CPI. So just a couple quick things, couple quick thoughts. This is just my stream of consciousness. Of course, none of this is investment advice. Consider this just a conversation about the markets. All right, so this is where we're at on the S&P 500. We've been testing this trend line a couple times. We've been getting clear rejections off this trend line pretty consistently. And the question now in this current market is, will we get another rejection, make another leg down, maybe come and test the support here at 3,800? We seem to have a pretty strong support here. We can move it right there. Looks like that 3,800 has been a nice bounce spot the last couple weeks. We saw a price move upwards from that spot. We also see that, and it's not too much of a key level back here, but we also see it was a key level here. Maybe this, if we move up our line right there, our key level 3808, it's been pretty consistent that we generally have not been able to break this in the near term. I'm talking about the last 3 weeks at least. The question is, will we reject this trend line, make a move to 3800 on the S&P, and then potentially break it, test new lows? I think that's a question that's on everyone's mind, whether that's going to be the case or whether we get a trend line break. But it all has to do with CPI reports in the next couple months. It has to do with future projections from the Fed, whether they're going to hike rates, lower rates, pause rates, whether they're going to slow down the pace of increase. That is just something we've been very much looking at across the board. Everyone's really concerned of what the Fed is doing, but I'm not going to talk about the Fed today. I'm going to talk about the current economy, and I'm just going to talk about one data point and just have a conversation around there. So we're going to be looking at the personal savings rate in America. Now, a lot of people, when they see this chart, they automatically think that now that we're sitting here around 2.2, 2.4%, they think that that is an indication of how much of one's general wealth is saved up. That is not the case with this stat. This is the personal savings rate on income. So if you make 100 grand, let's say that you're saving 2% of that 100 grand after tax. So that is how it is calculated. If we look at the last, this is a span from the 70s to now, the last 5 decades. Let's just focus on the last 2 decades. So from 2002 to 2022, we have entirely had a big shift from a very low reading back in the end of 2003, 2004, coming out of that dot-com bust, that 2000 tech bubble bust. We bottomed out at 2.1% on the savings rate, and then we slowly recovered. Surprisingly, through the recessionary times in 2008, 2009, during the housing market, we had a brief dip, but then personal savings rates did tend to come up as people were saving. And then we see this huge increase in the savings rate when we were seeing percentages of 30, 35%. This is that chart, but extended. We were seeing those elevated levels, and this was not a natural reading. This was all artificial. If you remember, this is when the stimulus checks were coming out. So the first and second round of, I don't remember if there's 3 rounds of stimulus or 2, but I remember the initial one, the big one, kind of was this big bump in 2020 during the COVID lockdowns. Economy is slowing. What does the government do? They pump money into people's banking accounts. So obviously this reading right here is elevated. So got an elevated level, and of course we're going to correct. We're going to revert back to the mean. That's what we have been doing. But mainly what the concern is, in the last year, so 21 and all of 2022, now that we're in 2023, all of that year it's just been dropping significantly. We had that second wave of stimulus here. I'm kind of flipping between the charts because this blue line gives you a better reading of what it has been like the last couple of years. But that second wave of stimulus bumped it up a little bit, but we've just been dropping ever since then. And that is not good for a couple of reasons. Reason number one is that at this reading here, we know that the average consumer, the average American, they do not have the means to continue participating in the economy like they have been previously. During COVID, we were spending money like crazy. Not me personally, but America was just trying to get out of that slowdown. That's what the government wanted. That's what kickstarted the economy. And the economy was red hot. And it still is red hot in certain sectors, even today, in 2023. The whole goal of the Federal Reserve raising interest rates is to slow down the economy, thus slowing down inflation. That is the whole goal. With that said, now that we are very, very low, and now that inflation is rising, so inflation or the CPI, that's the red chart or the red graph, red part of the graph. As that is rising, personal savings rate is lowering because cost of goods are going up and people have to spend money. So what does all of this mean in relation to the stock market? Why does this matter to us as traders, option traders? Well, I think my prediction is that we might make another leg down, whether that is here at this pivot point, rejecting off of trend line, whether we come up to 4,100, which was a very big resistance about a month ago. I remember when the SPX was at 4,100, the SPY was testing 40, oops, not this one. The SPY was testing 410. This was back here. We got up to 414 in the pre-market, but when the market opened, we cannot hold above 410. We immediately rejected on the SPY, came down to this trend line. This is a more comprehensive chart. It's a little bit ugly, so we're just gonna focus on the SPX. So going back to my point, if we're in a recessionary time, we might not get above 4,100. Why is that? We have earnings coming out very soon. So end of March, well, earnings season already kicked off last Friday, or actually yesterday. Yesterday we had all the banks report their earnings. We have more earnings coming out next week, and then we have the bulk of the earnings coming up middle of February and all throughout February. And as these earnings roll out, we're gonna start to see the effect of the Federal Reserve's monetary policy. We're going to start to see the effect if they were doing their job correctly, if they're able to slow down the economy, and I think they will. Now, the S&P 500, remember, is 500 of the largest companies. Of course, many of these heavy-weighted companies, such as Apple, the number one weighting, it has been absolutely whacked. It's went from about 180 to 125 in the matter of peak to bottom or near-term bottom. We have also companies like Tesla, absolutely decimated, 400 to 100. That is a 75% loss. We have Netflix, similar thing. We're looking at all these large tech companies such as Meta, the QQQ, which is the tech sector. All of this has been beaten down significantly. The question is now that tech is oversold or has been beat down the most, will the other sectors of the S&P 500, will they be the next to make a move downwards, bringing down the overall market? I think that might be the case. Let's take a look at IWM. This is an ETF on the Russell 2000. This is 2,000 of the mid caps. So this will be your smaller companies, not too large, not penny stocks, but kind of in the middle. These companies are generally what makes up of the US economy, similar to the S&P. I believe that it is the companies in this sector that are going to help bring down the S&P and make the next leg down. Obviously, we broke trend line. We'll see if we reject here at this significant level at 190, 188, this kind of vicinity. We see a couple rejections here, 1, 2, 3, 4. I believe if we get up to 188, that is going to be the true test in the near term and a potential opportunity to go short or at least hedge your portfolios to the downside. Now, we trade options here. What can we do to make money off of this? Now, this whole conversation so far, I'm going to get to my point. How do we make money off of this? But let's just backtrack real quick. This whole conversation so far is encapsulating what happens if earnings start to look a little bit weak in the Russell 2000 sector. Well, if earnings look weak, we are not surpassing 190, 188. That's just not going to happen. So going back, how do we make money from this? Well, we could trade in the money options. That is one way you can do this. Maybe you trade options expiring in March, all of March, maybe April. Give your options a window to appreciate. So anywhere from 48 days to 97 days. I think that would be a good range to play a downside move in the near term. Why do we want to do that? Well, if we have earnings coming out, it's going to take some time for the market to digest the earnings. And we don't want to be playing into that high implied volatility. So maybe just go a month after earnings. So that is one way you can make money off of this. In the money put options, let's say you're watching this video and you own the market, you own the S&P 500, you're a passive investor, but you do agree that we are in a potential spot for some more downside. You're not buying this market rally, you're sitting on the sidelines, maybe you have some cash on the sidelines that you want to deploy, but you do want to hedge your portfolio. You can still be a part of this downside move if you hedge your portfolio. I'm an options trader, and here at VIX Financial, we teach kind of swing trading, whether that's multi-day, multi-week. We do call options, put options. That's more of our strategy here. But if you're watching this video and you only want to hedge your portfolio, you could still participate and buy put options, maybe on the SPY. SPY options are very cheap when we're talking about implied volatility. So like we were looking at those 48 days to anywhere to 97 days. Let's say we do something in the middle, 62 days. The implied volatility of in the money puts is not too high. It's sitting here at 17%. That is very, very cheap. Cheap way to hedge your portfolio. Another way you can hedge your portfolio is buying the VIX or buying the VIX call options. You can't buy the VIX itself, but you can trade call options on the VIX. We know that we are oversold here on the VIX. We're trading below trend line. But if we were to just kind of pick out all the times the VIX was below 20, so we can look here in the near term. So we can look back to April of 22. We can look back to August of 22, and we can look at early December of 22. Every time the VIX is trading below 20, like it is now, that has been a market top. So like I said, April of 22 was a market top here. Market top here was August, below when VIX was below the 20. And then beginning of December was right here. It has been a market top every time the VIX is below 20. So another way you can hedge your portfolio or make money on the downside if the market is downsliding is buy VIX call options. I don't know why, but for some reason it's not showing me the options tab right now. But similar strategy, just buy call options expiring in March, maybe April, and limit that to maybe 0.5%, 1% of your portfolio. If you have $1 million portfolio, maybe throw in 10 grand or so in VIX call options to hedge your portfolio. So that's generally the conversation today. Just kind of how personal savings rate kind of gives you a look into consumers, kind of what their piggy bank is looking like. Maybe you can make some premature projections or premature guesses on the market and how earnings are going to come out. I'm not too bullish on earnings personally. Let's say you're a little bit in the middle. You can hedge your portfolio just in case. So that's gonna wrap it up for today. Just throwing up 2 charts for you guys and a conversation around where the VIX is at, where the SPY is at, and the SPX. So that'll wrap it up for today. Thank you so much for watching. Stay tuned for the next video.